Good morning, everyone. Want to go ahead and share another weekly note with you. It's May, it's springtime. More importantly, it is Mother's Day weekend. So I want to wish a happy Mother's Day to all the wonderful moms out there. We love you, we appreciate you, and we know that you're the glue that holds our families together. So hope everyone has a wonderful weekend celebrating the great moms out there. And yeah, we couldn't do it without you. So this week, I want to talk a little bit about markets, and I want to keep this short and to the point, make it relevant for you. It's been a messy market. It's been a down market. It's quite frankly, it's been ugly out there. Okay, and sentiment has gotten very negative over the last few weeks, last month or so. Let's talk about what's driving that sentiment and where we go from here. So what's moving markets has really been the same. It's been inflation, interest rates, Ukraine, Russia, and China's zero COVID policy. Okay? Specifically, I want to touch on interest rates and inflation because I think that's going to give us some perspective on where things go and it's going to give us an idea of what the impact might be to our portfolios and our investments. Now, this week was Fed week, Fed day on Wednesday when the Federal Reserve had their meeting and they announced interest rate policy. This has been a point of contention in the markets. Markets are scared that the Fed is going to move too fast, too quickly, too aggressively with interest rates, choke off growth in the economy, and send us into recession. That's the concern. Okay. Now we know inflation is a big problem. The last reading in March came in at 8.5% year over year. So things are more expensive than they've been, over 8.5% more expensive according to the CPI index. It's a problem. We gotta get that under control, and that's what the Fed is trying to do with interest rate policy. By increasing rates, you decrease the supply of money, and thereby, choke off a little bit of that growth that's leading to inflationary forces. The question becomes, can they do it? And they call it a soft landing. So can they do it in a measured way to reduce growth just enough to combat inflation, but not send us into recession and come down on a soft landing? The market's kind of voting no. We've already priced in, with where prices have been this year, it's a pretty negative outlook. But of course, the market is a forward-looking mechanism, so we could be seeing peak negative sentiment at this point. We could be seeing peak inflation. Some of the readings have come in that way already, and now the Fed starts to increase rates. It's going to start having the effect that they want to decrease some of that growth. So how does this impact you? Higher rates, we've already seen higher rates. The open market has adjusted on mortgages. They're up over 5% at this point on the 30-year fixed numbers. We've seen higher bond yields as well. Treasuries have really skyrocketed over the last few months. And that's been a function of just the Fed telegraphing what their policy is going to be. We know higher rates are coming, so the market has already adjusted. Outside of that, stocks, in a rising rate environment, in the initial stages of it, it's not terribly a negative thing for stocks, so we could still see some growth there. It's not going to be robust like maybe we've seen in the last few years, but we're not sounding the alarm yet. We're going to continue watching things. And at any rate, this is short-term stuff. As always, we're focused on the long-term, continue making automatic contributions, staying invested. Those are your best friends in situations like this as we work through the market cycles that we've been through in the past. If you want to get into a little bit deeper discussion on markets, I welcome you to just reach out. I'm happy to set some time aside to talk through it all. Outside of that, I wanted to touch on another topic that we've been getting a lot of questions on as well. It's about the Roth conversion. So in a down market, lots of people like to consider Roth conversions. Lower account values mean potentially a lower tax burden on the amount that you're going to convert. Because the amount you're going to convert is less and then you're still staying invested, it's going to come back up when markets do. However, there is one caveat, one thing I want to consider before we go ahead and make any of these decisions. That's what is your marginal tax bracket going to be? So we need to look at what your income is projected without the conversion, what tax bracket that puts you in. Then let's consider the conversion. So you're adding that on top of your AGI. Was that going to push you into another tax bracket? If it does, we definitely want to consider that, before making any decisions. Don't want to set off the tax bomb. I hate paying taxes, which is one of the main reasons the Roth conversion isn't always quite as attractive as maybe it should be. But again, with all things balanced, especially in a tax strategy, creating diversification. So that was the one thought from a planning side that I wanted to share with you this week. As always, the offer's on the table to review tax returns and do some planning here before we get into the summer months and things slow down a little bit. So please reach out. I'd love to hear your thoughts, questions, and just anything that's going on. So please reach out, and I hope everyone has a great weekend and enjoy Mother's Day.